So I think you still have to differentiate at the single stock level going forward into 2024. I think that will matter even more because the earnings momentum that we see is going to be even more differentiated across banks, I would say. The rising rate environment was a tide that, rose a lot of ships. Going forward, it's going to be more differentiated. So I think that's, again, why sort of active management of the portfolio will be key.
Hello to everyone. Now that we're 2.5 months into the year, we wanted to share some thoughts and views on financials, which is the sector that Algebris specialises in. The investment team's focus on the full capital stack of financials means that we are uniquely well placed to assess the dynamics across the sector and the opportunities for both the equity and the credit. So Benjie and I recorded a similar video in late Q4 with some other colleagues from the financial equity team. And really what we wanted to do was cover how the events of 2023 had impacted global financials and outline the opportunities that the team see have been presented for financial equities. So today we're going to focus on financial equities, and I'm very pleased to be joined by Benjie Creelan Sandford in his role as a dedicated analyst on European financials. So Benjie, I'd like to start really with quite a general question by asking you to summarise the investment case for financials as you now see it, please.
Yeah, so we're very positive on the outlook for global financials, and the investment case hasn't changed substantially over the past few months. The reason why we are more positive is that you've had a couple of pretty big structural changes versus what preceded in the past decade. One is that interest rates around the world have generally gone up, and in many places have exited negative territory. That's transformational for profitability for banks in the financial sector. And the second element is that the big push on regulation post GFC and the need for banks to build more and more capital is now largely at an end. And that means that the improvement in profitability is also feeding into an improvement in returns to shareholders via capital distribution. So yields across particularly European banks, we think are extremely attractive.
Okay, and there's one very strong point there, is that lots of commentators and lots of investors ask us about where interest rates might peak. And the important point here for the banks is not how high interest rates go, it's the fact that they've gone from zero or negative to something. Yep.
Exactly. And look, if we think about what's changed over the past few months, interest rate expectations have moved around a lot. So we've gone from, higher for longer rates to, the back end of last year, there's an expectation that rates were going to be cut very quickly. We've now kind of gone back to somewhere in between, where we're looking at some point this year, the expectation is that, rates will start to come down. But the crucial thing is that, we are very comfortable for rates to come down in terms of the outlook for European banks, for example. Certainly one of my bigger worries over the past 12 months would have been more about rates staying too high for too long, and the implications that might have for asset quality. I think if rates come down and sit in a 2 to 3% level, that is a real sweet spot for banks, because it allows them to make a very attractive return in terms of the margin that they can earn, but also, rates at that level underpins the economy, doesn't create too many problems from an asset quality point of view, etc. So in the round, the profitability, although margins may come down slightly versus where they were at peak rates, in the round, profitability is still going to be very attractive.
Okay, and then just taking that point a little bit further, what are your thoughts on the earnings outlook for 2024?
Yeah, well, we've seen that as we've just gone through full year results. That was a bit of a litmus test for European banks in particular, as as I say, as rate expectations had come down, people started to worry about the resilience of profitability, whether we were going to see big downgrades on expectations. Actually, over the past few weeks, as we've gone through full year results, we've actually seen modest upgrades to expectations, and that's because net interest income is proving more resilient, even as rate expectations come down. So banks are benefiting still from lower deposit costs. and that's partly because liquidity conditions are typically much more favourable than they have been in prior cycles. So there's no real push for a competitive drive to raise prices to gather deposits. And secondly, banks aren't operating in a vacuum, so they are actively trying to manage their interest rate risk. And over the past months and quarters, banks have been trying to reduce their interest rate sensitivity in preparation for rates coming down. So even as we see rate cuts coming through, it doesn't necessarily feed negatively into net interest income as quickly as you might have expected. So the earnings outlook for 2024 on the top line, resilient. Overall, still not seeing any meaningful deterioration on broader asset quality, so provisions also still very benign. So net, as I say, we're landing at a result where earnings expectations have actually been revised up slightly over the past month.
And the trend continues in that way, is your view?
Yeah, I think, look, as we look further into 2025 and rates coming down, that will start to negatively impact the top line. So you will see some pressure on margins coming through. But again, there are offsets to that as rates come down. So, if we get more certainty about the rate outlook, that, as I said before, that underpins the economic outlook. So there is a prospect for volume growth to pick up. Certainly activity, again, it's the purpose of tighter monetary policy is to subdue activity levels. As rates get cut, volume growth can come back. Some other business lines that have suffered as interest rates have gone up can also come back. So, a lot of the fee-driven activity for banks, if you think about, asset management, some of the investment banking lines, etc., those can start to show more momentum in a lower rate environment. And as I say, provisions at this point, we're still not seeing any, at the broader sector level, we're not seeing any signs of major concern. So as we go forward, we do think profitability may come off the peak, but that still allows banks to make a very attractive return, still allows them to deliver on very substantial capital return, and neither of those things are in any way reflected, we would argue, in the current valuations.
Understood. Okay. And I just want to take a little look back at 2023, because despite 2023 being extremely challenging for the sector, we finished the year with strong performance. And obviously that's a demonstration of well-executed active management. Whilst the performance was generated across the year, the last 2.5 months were particularly strong. So can you just explain why the last 2.5 months were so strong? And then also, given the macro environment where we are in the interest rate cycle, is now a good entry point?
Yeah, so I think, the issue for banks in particular is that, you've gone through a number of years where, if you weren't invested in banks, you didn't necessarily lose money. They have been a sector that has underperformed, on a generic level. So there's a lot of skepticism about the sort of the resurgence of banks, and there's been lots of question marks about whether the earnings that we're currently seeing can be and will be resilient. We've just discussed the reasons why we think it is. But I think from the market's point of view and the valuation point of view, it takes time.
There's a muscle memory.
Exactly. And I think it's just, so even though, banks have outperformed over the past 2-3 years, actually in relative valuation terms, they're still near kind of trough valuation levels relative to the broader market. So part of the reason why the performance has been stronger through the second half of the year is, again, just banks being able to demonstrate that they are delivering on the revenue growth, provisions aren't deteriorating, and therefore we have seen a little bit of a pickup in the multiple. And also, we've seen more distribution, dividends, buybacks coming through, which again, becomes more and more difficult to ignore as time goes on. So I think that's why you've seen a bit of a pickup in the second half of the year. I mean, look, we've been talking so far at a very high level about the sector. For sure, there are individual names, individual situations where the picture is not as rosy. If we look at the US, for example, Recently, we've seen commercial real estate concerns and risks really coming to the fore. CRE risks certainly exist in Europe, and there's pockets of it there as well, but at a more general level, CRE exposure of the European banks is much lower, and the growth over the past few years has also been much lower, again, partly because of the lessons and the experiences that those banks had coming out of the global financial crisis. So I think you still have to differentiate at the single stock level going forward into 2024. I think that will matter even more because the earnings momentum that we see is going to be even more differentiated across banks, I would say. The rising rate environment was a tide that, rose a lot of ships. Going forward, it's going to be more differentiated. So I think that's, again, why sort of active management of the portfolio will be key. But as I say, at a general level, we still think broader financials and banks is an attractive space to invest in, because even though you have seen very strong outperformance relative to the market over the past 2 to 3 years, the valuation multiples are still extremely low, because basically share prices have barely kept pace with the extent of positive earnings revisions that we've seen.
Okay, and then just to drill down into a little bit more, in terms of share buybacks, it's something that we're hearing a lot more about these days, particularly in relation to European banks. It'd be helpful if you could just talk through exactly what it is and what it means and why it's beneficial for shareholders, investors. Why are banks now able to do it when they weren't previously?
Yeah, so very simply, buybacks are an alternative form of distribution rather than dividends. So, what's the advantage for you as a shareholder? Rather than bank or the company coming and handing you a cash dividend, what the company does instead is agrees to spend that amount of money just buying back shares in the market and then cancelling those shares. So as a shareholder, you don't receive a check in the post for your cash dividend, but the number of shares in the market are shrinking once the company buys them back, and therefore the relative value should improve. Now, there's various inputs and various ways you can debate the relative attractions of a dividend versus a buyback, but certainly for European banks that are trading at a discount to their tangible book value, buying back shares can be extremely accretive because you're basically buying back something below par, and therefore you can really accelerate that share count decline. So you really turbocharge your accretion both in TNAV and earnings. So that's why buybacks, we think are attractive for the European banks in particular. And to say the reason why we're seeing more of that is, going back to the kind of the two big structural changes that we talked about at the beginning. One, profitability has improved quite markedly, and secondly, European banks are now on the whole sitting in excess capital. They're not needing to build more capital, and therefore, as that profitability improves, that is actually finding its way back to shareholders via distribution.